Hello friends, welcome to the investment banking tutorial of Wall Street Mojo. Today's topic is defensive interval ratio, and this is one of the most important ratio which a company which an investment banker usually looks at when they want to assess the financial liquidity position of the company. Defensive interval ratio basically helps us identify how strong the company's liquidity position is. And obviously, as in case of other ratio, this also needs to be compared with the other companies in the same industry in order to decide whether or not the said ratio is good or bad. Because as you all know, that ratio is a relative term or it needs to be assessed relatively in comparison to its other peers. Let us try to understand this with the help of an illustration in the form of a chart. As you can see, there are two charts in front of you. One, Apple's defensive interval ratio and Walmart's defensive interval ratio over the last 10 years. How is the trend of both the companies' defensive interval ratio over the last 10 years? As you can see, the Apple's defensive interval ratio has been significantly higher as compared to Walmart, and it currently stands at around 4.048, whereas Walmart's defensive interval ratio is around 0.579. Now, what this indicate? This indicate, or basically at any defensive interval ratio indicates how many days, years or month the company will be able to survive based on its current assets of the company. That means without using its non-current assets, how many days the company will be able to survive. That means the company wants to, if the company wants to repay all its expenditure or want to pay all its expenditure, in that case, the company don't need to touch upon the non-current assets. Even without touching the non-current assets, how many days the company will be able to operate. Let us try to understand this with the help of a basic exam. But before that, let us try to see what is the formula of defensive interval ratio. Defensive interval ratio is equal to current assets of the company divided by average expenditure. Friends, I'm writing over here average expenditure. If you want to compute your defensive interval ratio in terms of days, in that case you need to use average daily expenses. Whereas if you want to compute the defensive interval ratio in terms of years, which was there in the example that we have considered for Walmart and Apple, in that case you need to compute the average annual expenditure. Okay, so it depends which kind of ratio you want to compute, and if you want to use the average, if you want to compute the yearly defensive interval ratio, in that case you need to use the average annual expenses. Clear? Now let us try to understand this with the help of a basic example. Suppose a company has a total current assets. What is current assets? We will talk about it. But suppose the company has a total current asset of around $750,000. The company has a total current assets of around $750,000 and its average expenses. That means on an average, the company spends on a yearly basis. Average annual expenses. The average annual expenses of the company is say $65,000. That means every year, on an average, the company spends around $65,000. In that case, what will be my DIR, which is defensive interval ratio? And what is DIR? Defensive interval ratio is current assets of the company divided by average expenses of the company. And in this case, I'm getting a DIR of 11.53 years, right? Now, what does it mean? It means that if the companies want to continue meeting its expenses, in that case, if the company does not want to touch its non-current assets, that means does not want to sell any of its non-current assets, in that case, how many years the company will be able to operate? And how we have computed this? We have first seen what is my annual expenses. On an average annually, how much I spend, right? In that case, and based on my current assets, my total current assets was $750,000. So based on that, I have computed that if I have to spend every year, how much I need to spend. Let us try to understand this within common parlance. Suppose I have a total pocket money of $500. Okay, I have a total pocket money of $500, and every day I spend around $50 on my foodings, on my travel, etc. I spend $50 every day. In that case, how many days I will be able to use, in how many days I will be able to exhaust my entire pocket money of $500? I will be able to exhaust the entire pocket money in 10 days, right? This is called as defensive interval ratio. Okay, so for a company's perspective, the $500 is nothing but the current assets, the assets which currently the company has, which the company can use. And $50 is basically the annual expenses or monthly expenses of the company, which the company needs to pay, right? Let us try to understand both these terms. That means, what does the term current assets mean and what does the term average expenses mean? Current assets, friends, as you know, is nothing but cash plus marketable securities plus trade accounts receivable. Basically, in your balance sheet of the company, you will find two segments. In the balance sheet of the company, you will find non-current assets, and in the balance sheet of the company, you will also find a current asset. Under the current asset section, you will find all these three items. That means cash plus marketable security and trade account receivable. Friends, in case there is any other assets, any other item which is mentioned in your current asset section, you need to first evaluate whether you can realize cash out of that current assets. For example, if I have some deferred income tax, okay, if I have some deferred corporate tax, in that case, I cannot use that or cannot realize the cash out of it. So you need not consider it. So only three items needs to be considered, which is cash plus marketable securities plus trade accounts receivable. And why marketable securities? Because marketable securities, although you don't have a cash available, but those securities are something which you can sell in the market and realize the cash, right? What does the term average daily expenses means? Average daily expenses or monthly or quarterly, you can compute it anyway. Average expenses is nothing but cost of goods sold. Cost of goods sold means the cost of the goods that you have sold to the customers. So cost of goods sold plus annual operating expenses minus non-cash charges. Now, cost of goods sold should be very clear. It is basically the cost which is incurred by me in manufacturing or purchasing the goods that I'm selling to my customers, right? So that will something which I'm going to incur. Annual operating expenses is also clear because that's the something which I need to expend in order to continue my business. But why I'm reducing non-cash expenses or non-cash charges? I'm reducing non-cash charges because in this cost of goods sold or annual operating expenses, there can be certain expenses which are non-cash. That means although those are charged to my income statement, but there is no real cash outflow from my side. For example, if there is any depreciation in that, for depreciation, while depreciation is an expenses for me, but there is no cash outflow which will be there in case of depreciation. And therefore, when I'm assessing the liquidity position of a company, I need to include that amount from my total expenses, right? And accordingly, I'm going to compute my average expenses. So cost of goods sold plus annual operating expenses minus any non-cash charges. Now, if you are computing this for daily expenses, that means you're computing average daily expenditures. In that case, you need to divide this by 365 because this entire amount is the annual cost. But if you are computing annual average expenses, in that case, you don't need to divide it by anything. Again, if you are computing average monthly expenses, in that case, you need to divide it by 12. Okay, so based on your computation, it is going to change. So friends, coming back to the point that we discussed, if there is, when we are saying Apple defensive interval ratio is 4.048, what does it indicate? It indicates that Apple can continue its expenses or can meet its expenses for 4.048 years, assuming that it's an annual 4.048 years without even selling even a single dollar of its non-current assets. Whereas Walmart's 0.579 indicates that we can continue the business for 0.579 years without touching the non-current asset. And as I mentioned, we need to see it on a relative terms. Apple and Walmart don't operate in the same industry, right? And therefore, if we want to comment whether Apple defensive interval ratio is good or bad, similarly, Walmart's defensive interval ratio is good or bad, it depends upon its peers in the industry, right? Peers in the same industry. And therefore, only then we will be able to conclude on whether it is good or bad. Thank you.